The US Treasury market, long considered the bedrock of global finance, is facing unprecedented volatility. Yields on 10 years and 30-year bonds have surged to multi-year highs, reflecting deep concerns about America's economic future. In this video, we'll touch on the US fiscal trajectory, trade policy shocks, and shifting global reserve dynamics. My name is Huan Zi, Manager of Dealing and Investor Education at PYTCH. Today we analyze why Treasury yields are rising, the implications for investors, and strategies to navigate this uncertain landscape. There are three forces driving this historical sell-off of US Treasuries leading to yield surge. First, soaring fiscal deficits. The US deficit have ballooned to 6.4% of GDP in 2024, amounting to 1.8 trillion, driven by tax cuts and spending bills. The recent Republican-backed tax legislation alone could add 3.8 trillion to the deficits over a decade, raising fears of unsustainable debt levels. This is also reflected in Moody's recent downgrade of US credit rating from AAA to AA1 on 16th of May 2025. Second, raising stagflation risks are linked to renewed tariff policies. President Trump's aggressive tariffs have injected volatility into growth and inflation expectations. Economists warn these policies could trigger stagflation, where slower growth results from higher import prices while pushing inflation above Fed's 2% target. Third, we are seeing a notable shift in global reserve management. Central banks such as China and Saudi Arabia are reducing their treasury holdings in favor of gold and alternative reserves. Global central banks' annual gold purchases exceeded 1,000 metric tons for 3 consecutive years, from 2022 to 2024. This reflects declining confidence in the dollar stability amidst trade wars and geopolitical tensions. Let's look at how the global markets are being impacted. One major shift is in borrowing costs. The 30-year yield reaching 5% represents a seismic shift in the economy. Mortgage rates have surged past 7%, squeezing home buyers' affordability. Corporates are delaying expansion plans as borrowing costs become increasingly costly. It is unsurprising to note that the US government spent more on interest payments at $881 billion than defense at $855 billion in 2024. Another key development is the erosion of Treasury safe haven status. For decades, investors regarded Treasuries as safe haven during crisis. Long-term yields now trade at a premium to interest rate swaps, a clear sign that markets are pricing in risk in risk-free bonds. Meanwhile, the dollar has declined 8% against a basket of currencies since January, as reserve managers diversify into other assets, further underscoring this shift in mentality. Despite the turbulence, there are still opportunities for investors who remain selective and proactive. One area of focus is shorter duration bonds. Investors can lock in on a higher short-term yields while minimizing risk exposures by focusing on 2 years to 5 years Treasury or investment-grade corporate bonds. An option to gain exposure to the asset class could be an ETF, such as iShares 1 to 3 years Treasury bond (SHY). Another area of focus is gold and inflation hedges. Central banks purchased more than 1,000 metric tons of gold last year, with the trend continuing in 2025. Gold prices have also reached multiple all-time highs this year, making physical gold ETF such as US-listed GLD or SGX-listed 087 and gold miners become potential investment choices that thrive in inflationary cycles. Amidst these developments, there are two key risks that investors should continue to monitor closely. The first is policy uncertainty. The constant back and forth of events revolving around the US tariff on global trading partners worldwide brought about extreme volatility in the second quarter of 2025, with more clarity only expected after trade talks are completed. And with no clarity in the future of tariff, the short-term optimism on potential trade deals has to materialize by July, or risk shaking up global markets once again. The second is sustained weakness in the US dollar. If the greenback further weakens, it might trigger a vicious cycle where foreign investors sell treasuries to avoid currency losses, which in turn pushes yields even higher. Central banks might also continue to reduce their stake in the dollar in currency reserve in favor of other safe haven currencies or gold. Investors can monitor the Bloomberg Dollar Index, where a key level to watch will be at 1,200. The US Treasury is at crossroads. While yields offers attractive income, investors must balance between opportunities with risk posed by deficits, tariffs, and shifting reserve dynamics. Diversification into gold, shorter duration assets, and selective EM debt can enhance resilience. Remember, in times of uncertainty, the best investors don't predict the future. They prepare for multiple outcomes. That's all for PhillipCapital's Market Watch. Don't forget to follow us on all our social media platforms for more content. If you found this video helpful, remember to like, share, and subscribe. And stay tuned for more episodes. Thank you for joining us and see you next time.